Good afternoon, everybody. I'd like to call the December Finance Committee meeting to order. Doug, is there any public comments?
I don't believe there are any public speakers.
Okay, seeing none, then I'd like to have a motion, please, to approve the minutes of our November 26th Finance Committee meeting. All in favor? Any opposed? The minutes are so moved. Doug, would you take us through the work plan, please?
Yes, sir. There are no changes to the work plan for December. At the September meeting, the board approved a different work plan schedule and for 2013. So we've included for your information a proposed work plan that you can take a look at, and if you have any suggestions or deletions, whatever, we can talk about that the following month in January.
Okay. Finance Watch, go ahead, Doug. Why don't you just...
Yeah, we have no Budget Watch this month, and we have Finance Watch, Pat McCoy.
Thank you. Good morning. Finance Watch appears on page Roman numeral 4-1 of your committee book this month. And we begin with the discussion of our most recent two fuel hedges. The first was executed on October 24th, 2012 for a notional amount of $24.2 million at a price of $2.89 a gallon. And this will cover us for just under 8.5 million gallons of fuel. Goldman Sachs was the winning bidder. This was a competitively bid fuel hedge, and the trade terminates on October 31st, 2014. You'll also note here that we did get executed documents in place with a third counterparty. In this case, it's J.P. Morgan Ventures Energy Corporation. It's guaranteed by J.P. Morgan Chase Bank. They've been added as a fuel hedge counterparty, rated A2, A, and A+. Our next fuel hedge for 28.8 million was executed on November 19th. J.P. Morgan was the winning bidder of this hedge. This was the first trade won by this newly added counterparty. The all-in price is $2.94 a gallon for a total of about 9.8 million gallons of fuel. And this trade terminates November 30th of 2014. Next, we report on a termination of 3 tax advantage leases on December 1st. MTA made payments to the equity investors totaling $2.8 million to effect the termination of these leases. These terminations will benefit the MTA as a risk-reducing measure due to the equity payment agreements with FSA Capital Market Services. FSA is at risk of a downgrade, and if this were to happen, we would be at risk for having to collateralize these agreements. And so, Jerry Page and Paul Acera did a good job of negotiating these terminations, and that were approved by the board last month.
I certainly would second that.
Thank you. The next update concerns the initiation of rating review of the TBTA credit by a new rating agency, Kroll Ratings. Kroll is a newly recognized rating service that is becoming more active in the tax-exempt municipal market. They initiated ratings of TBTA at AA for general revenue bonds and AA- for subordinate bonds. These ratings are one notch higher than where the other 3 agencies rate TBTA, and I'll just give you those ratings now. Moody's is at AA3 and A1. S&P is at AA- and A+, and Fitch is at AA- and A+. So, I think this just gives us, a deeper insight into the TBTA credit for the investment community, and, we'll continue to work with Kroll on that rating.
Cost on that?
Cost on that is $25,000. And that's a cost of issuance that's paid out of the transactions where we issue bonds.
It's the same outfit that used to do
Investigations. It's the same name. The founder of the company is Jules Kroll.
Jules,
yes. Yeah, he sold off that investigation company some 7 or 8 years ago, and Kroll is his current venture, if you will. Yeah, Kroll Ratings, I should say.
We used to Krollerize people.
Okay. Yeah. Okay. So next we turn to upcoming issuance, and I want to report on the TBTA refunding transactions, which were originally scheduled to price last week. You may recall on December 7th I emailed you the preliminary official statements for two transactions that were to be priced as one common plan of finance, the 2012C subordinate bonds and the 2012D senior bonds. These are all Triborough. Capital markets last week seemed to go into a stall and caused us to hold off on pricing the bonds. Several transactions last week struggled to be digested by the market, most notably a Connecticut special obligation bond, which last Tuesday evening, before we were to get into the market, had large unsold balances in excess of $100 million. Just to give you a sense of market moves, market rates for 20-year bonds since last Monday increased by 17 basis points. On top of this, credit spreads widened significantly as well. We can't point to one specific catalyst for the behavior of the market to seize up the way that it did, but we do know that there is, continues to be wide concern and uncertainty regarding possible federal actions to address the impending fiscal cliff situation. There was a notable downgrade last week of Puerto Rico by Moody's to the lowest investment grade before junk status, and that had a very chilling effect on the market. So in short, after we consulted with our advisors and the underwriters, we decided to keep the transactions on a day-to-day basis. We are looking for the investment community to signal that they are ready to buy bonds at the levels that MTA finds attractive. I would just note, let me be clear, we do have market access, but it would come at a higher yield and more importantly at a higher spread than what we would expect and desire. And that's why we're waiting, quite frankly. If we're unable to issue the bonds and get into the market by this Wednesday, at that point we think we'll just table this until next month when we expect a more orderly market. So,
And let me just point out, it's not that we would not have savings were we to issue bonds in this market at these levels. It's just the savings would be significantly less than what we have been experiencing, because we've been seeing really good market acceptance and at very attractive rates. The absolute level of rates right now is still attractive, but Ian, we don't have to do the refunding, so we're just going to wait until hopefully markets improve and we're able to maximize our refunding savings. Pat?
yeah. Okay.
When you're talking about getting orderly, you're waiting till after the first of the year. Is
Right.
that kind of like going to be a barometer or something to see what the president does?
Well, I think that's again part of the equation. The other part is the large institutional investors that we look to support our bond transactions. They're closing their year out pretty soon.
Yeah.
January 1st is a significant redemption date in the market where a lot of cash is freed up, and we would expect that to also have a positive effect on the reception of our bonds, is that there's money to be put to work. So when I say orderly, we just expect just more
You'll know what's going
receptivity to supply. Last week was a heavy supply week. There was about $12 billion in new money issuance in the market, but in addition to that, for the last 3 days of the week, Wednesday, Thursday, Friday, we estimate that there was at least 1 billion bonds sold into the market by investors who were just reducing their positions. That has a significant effect on the market. Obviously, it's not attractive for us to come in with more supply to that equation and expect aggressive rates.
Okay.
That could just be
Yes, Mr. Chairman, I understand that we received some news on Sandy-related borrowing that may take place, and I was also wondering if the refunding exemption that we have for debt for this year, if we don't has it been clarified that we will continue to be exempt from the fees if we make these transactions in January as opposed to making them this week?
No, the exemption that the Division of the Budget granted does apply to these particular bonds, the subordinate bonds, whether they happen now or in 2013. There are some additional bonds we identified under the senior resolution that would be advance refunding candidates. Those are not part of the exemption. We have requested those bonds to be added. We haven't heard back from DOB on that.
But I would say that when we have requested that additional bonds be added, they've complied. So they've worked with us on that in that regard.
And it's correct that the Sandy money we've been granted relief on the Sandy debt?
I know we have asked. I don't know whether we've heard definitively yet.
Yeah, I don't know if we've got anything in writing, but I understand that there was,
Yeah, there was a conversation
yes.
specifically on this.
Okay, thank you.
Sure.
The last thing I would report on is that we are moving forward with the remarketing of TBTA Series 2005 B4A bonds. This is a small $29 million bond that's currently in the index floating rate mode. We expect to be able to get this into the market on Wednesday. It's a very short piece of paper. We expect to remarket this for a one-year term. And it's obviously a small size, and we don't think that the current market conditions are going to greatly impact what we're trying to achieve here on that. And we'll report on that next month.
I was reading that. I figured we left off a zero.
Yeah.
It was so much smaller than all the other ones.
Right.
That we've done.
Yeah. So, any questions, or that concludes Finance Watch, Mr. Chairman.
Doug, would you take us into the action items, please?
Sure. The first action item is approval of the MTA 2013 budget and 2013 to 26 financial plan. And Bob Foran is here to describe what we're looking for.
The presentation we made last month, the November plan, nothing has changed. So what we are bringing to the board this month for their approval is still that November plan. And if you were to turn to this budget adoption book, I'm going to walk through what our recommendation is, and it's on page Roman 1-4. It's recommended that the board adopt the 2013 final proposed budget and four-year financial plan, 2013 to 2016, collectively the November plan, which includes approving the 2012 final estimate, all plan adjustments. The approval of this plan will supersede prior board plan approvals for this period. It authorized staff under the guidance of the CEO and the Chief Financial Officer to take actions to implement the subsidy and other technical adjustments set forth in the plan. Authorized technical adjustments to agency budgets and forecast of a non-material nature in the February plan. Authorize adjustment of agency 2013 budgets and forecasts to reflect labor settlements approved from time to time by the board. Approve additional budget and cash management actions as has been done in past budget adoptions, including advance of bridges and tunnel operating surplus, use of the MTA MRT 2 corporate account monies, use of payroll mobility tax and replacement funds and MTA aid, to authorize the CEO and Chief Financial Officer or their designees to enter into interagency loan agreements among the MTA and affiliates and subsidiaries, and use of the stabilization reserve. The Treasurer is also authorized to use the GASB accounts to fund intra-agency loans as well as interagency loans. Recall that the 2013 final proposed budget includes borrowing of $75 million of these funds to close the gap caused by Tropical Storm Sandy. If an agency uses its own GASB funds to meet the 2013 cash flow needs, the amounts withdrawn in 2013 will be paid back by December 31st, 2015. If the GASB funds are used as interagency loans in 2013, they would be subject to repayment no later than December 31st, 2014, consistent with the interagency loan provisions described above. The expectation is that the money that would be borrowed would be coming from each agency, and so, again, we could borrow that money through 2015. That's it.
Now, do we need a vote on this?
We need to move it. Yeah.
Second?
Second.
We have a motion and a second. All in favor, please?
Can I ask one question? Am I correct that this proposal still contemplates zeros in the labor agreement?
Yes, it does.
Thank you.
Just a comment. I know that Commissioner Albert had made a comment at Transit regarding fare evasion on the transit system, and I just want to add to that Long Island Railroad Commuters Council's ongoing concerns with the lack of fare collection on the Long Island Railroad, whether it's, and it was evidenced by the last fare increase in the way that was handled with with the short times on redemption of the one-way and round-trip tickets and the 10-trip tickets. I know that was changed, but and maybe it's the impact of Sandy, but there's been an ongoing issue of not collecting fares on Long Island Railroad and people actually adjusting the kind of trips they buy. So I just wanted to put that comment, and the impact of that on the budget is not, I do not believe, is small. That's been in the press. I think it's something that we should take a good look at. Thank you.
Okay, so we have a motion, we have a second. All in favor, please? Aye. Any opposed? Your budget's approved. Okay, so noted.
Next, we have the 2010 to 2014 capital program amendment, and Hillary Ring is here to explain that.
Thank you, Doug. You should have an attachment here that's a book, Capital Plan Amendment. I'll just quickly walk through what the thought is here. Even though the MTA agencies took steps to protect their assets from the hurricane, the storm's water and wind caused extensive damage throughout the system. And while we've done well to resume most services through removing debris and making interim repairs, we have many damaged assets that remain and need repair and possibly replacement. Failure to repair or replace these assets could have a significant impact on our service reliability over time. Based on the agency's initial assessments and surveys of the damage, the estimate to restore affected assets is $4.755 billion. This includes $3.5 billion for transit, $800 million for bridges and tunnels, and $455 million for Metro North and Long Island Railroad. The amendment before you increases the 2010 to 14 capital program by $4.755 billion. The budget is located separately from the agency's stated good repair program in an area designated for disaster recovery. The work is expected to rely on new funding from a combination of sources, including insurance proceeds, reimbursement from the federal government, and potentially additional MTA bonds or tri-borough bonds if local match is required. It's necessary to add the work to the capital program now because the work will likely happen before reimbursement is concluded, and MTA will temporarily utilize interim financing instruments, which Bob will go through as another action item soon. If you look in this book, the capital program amendment, attachment A, the pages aren't numbered, but attachment A shows the existing capital program and then the proposed changes. Attachment B shows how the $4.755 billion in repairs is broken out by agency. And then attachment C shows essentially the funding. So what we're proposing here is both on MTA and Triborough, which are separate because Triborough is not subject to the Capital Program Review Board approval, to show that, for example, on attachment C, we're expecting $3.185 billion in proceeds from federal reimbursement, insurance, FEMA, things like that, with the potential for another $792 million in MTA financing, and similar breakdown for Triborough. It's the intent to go to should the board approve this at the meeting on Wednesday, to send this up to the Capital Program Review Board in Albany for action as quickly as possible, which will allow us to issue bond anticipation notes, which are the next action item. We can't issue the bond anticipation notes if we don't have the authority for the issuance of bonds. And the reason why we're issuing the bond anticipation notes is because that's the vehicle that we're going to use while we're awaiting the reimbursement from the federal government or from insurance proceeds. So you look confused, Ira.
The term bond anticipation notes?
So essentially,
Sounds like a note on
we're
a
going
note.
to be issuing, we need to come up with cash to pay for the repairs. We're going to be eventually getting reimbursed from the federal government for those repairs. In the meantime, we still need to come up with cash. The best vehicle for that is for us to issue bans, and then keep the bans out and then take them out with the reimbursement once we get it. We can't, right. So we can't, however, well, because we can't issue bans unless we can issue bonds. We can't issue bonds unless it's in an approved program.
But the plan is not to issue the bonds, hopefully to get the money back.
That's correct.
Have to issue the bonds. Because we don't know if we're going to get the money. Okay, that's why they're
Right.
called bans.
Question? Hillary, how much time are you allowing for FEMA to reimburse MTA? Is there an expectation of within 2 years or year and a half or?
Lorene Coyne, Director of Risk Management, can answer that.
We are looking at possibly 2 to 3 years. It could take as long as 2 years to actually get all the programs approved in the closeout. For Irene, it took us 1 year to close out.
And there's also, it depends on the language that the appropriation in Washington, the way it's drafted. If it's through the FTA and not FEMA, it might be different. So it's still an open issue. Notwithstanding any of that, we still need to move ahead with starting our repair work.
Excuse me. The plan sounds very logical, and the way you're doing it sounds appropriate, and using the existing credit, it all makes a lot of sense. But if you're issuing 2-year bans, is that the plan? What if the money is, how long will the ban, what's the maximum term of the ban?
So we can issue bans up to 5 years. So
Oh, okay.
And we'll look at.
So you could roll them if you're,
we could
if there's
roll
a
them.
delay in part of the money, as was just explained, we can do a partial rolling, pay off some and roll.
Correct.
Okay. Great.
Right, and we'll build in. We'll build in redemption language that will allow us to to call them early if we get proceeds of insurance or FEMA in early.
Yeah, great. It all makes sense. Thank you.
So you all understand the action item that's presented. May we please have a second? A motion, well, I guess we have motion and a second.
Second.
All in favor? Anybody opposed? There we go. Now you got another action item. Doug.
Yeah, we're looking for authorization to finance Sandy repairs, and Pat's going to describe that.
So now what we're looking for a motion on is a discussion beginning on Roman 5-1 of your committee book, and this is authorizing the issuance of bond anticipation notes as well as bonds in an amount of $2.5 billion. $2 billion identified for transit and commuter-related projects, and $500 million for TBTA projects. And this could be done under the Transportation Revenue Resolution, the Dedicated Tax Fund Resolution for those transit and commuter projects, and for bridges and tunnels, it would be under the Triborough Bridge and Tunnel Authority. So we're not anticipating or contemplating any use of Triborough's bonding capacity for transit and commuter side of the operation. Again, this is strictly for Sandy-related repairs until such time as we get FEMA money or insurance money in to take out the bans. In the event that any portion of those bans are not repaid with FEMA or insurance money, this action would authorize the issuance of long-term bonds up to an amount of $950 million total, which is, again, what we estimate the sort of the maximum exposure would be that would not be covered by FEMA and insurance.
And that is the number that we've included in the financial plan as well. Now, 950. Now you might ask, we just put that we'd need possibly interim financing of $4.755 million. We're only asking for $2.5 billion at this time. It's because we anticipate that it will be time before we have to draw the funds down as we see the timing of the reimbursement coming in from insurance or from FEMA or from the federal government. We may be coming back to you asking for additional authorization. But at this time, we think $2.5 billion gives us what we would need to address the interim funding.
Could you,
Jim and then Mark.
No, Mark, go ahead.
can you clarify what we just voted on? Because I thought the bands were in it. Could somebody just explain to me what we just approved?
Yeah, what you just approved is authorization to sell $2.5 billion of bands and
No, no.
two.
The
I'm sorry.
amendment.
What that was an amendment to the capital program, and when we make an amendment to the capital program to include all of the Sandy-related infrastructure losses, the 4.755, we were also putting in there what we expect to be the funding sources for those. And we expect the funding sources initially to be interim financing of notes that we would sell, so bond anticipation notes, that would be reimbursed or repaid probably from insurance or from federal funds, and to the extent not, they would be funded with long-term bonds. And by doing this, and having projects that are in an approved capital program, we have the ability to sell notes and bonds for this purpose. And so that's what we were asking is let's amend the capital program, which would give us, at least for the transportation purpose, the ability to sell notes and bonds to cover the interim and potentially permanent capital.
However, you're saying that that was not, in fact, an approval by this board of the sale of those notes and bonds, and that's what you're asking for now?
That's it.
Correct.
And the total amount of bands that you're looking to have us authorize now?
$2.5 billion.
And the total amount of long-term bonds that you're asking us to authorize right now?
$2.5 billion.
Good, okay.
Okay.
I have one about the,
Pat, you said that you were looking for $995 million as a source for taking out bands that were not in fact paid for by insurance. Now, I thought that was the number that we were going to be on the hook for, period. And that so you were, I would think you would need authorization to go beyond that in the event that you didn't get the expected recovery from either insurance or from FEMA.
Well, again, we don't authorize the issuance of a ban unless it goes hand in hand with the authorization of the bond to repay the ban at some point. And when we say at some point, within 5 years. So when we talk about the $950 million, we estimate, again, this is all estimation, we estimate that that is the maximum exposure we would have for Sandy-related damage that is not available for recovery by either insurance or the federal government. So within that $2.5 billion, I think what we're saying is the worst case scenario is that $950 million would have to be issued on a long-term basis. Sorry, Mark.
I'm sorry, I shouldn't interrupt you particularly, but as a technical matter, to issue the bands, you have to authorize the long-term
Yes.
bonds. What the investor is counting on when he buys the bands is your obligation to take it out with a long-term bond. If we manage to get somebody else to pay for it in the interim, that's kind of our affair, and obviously that's something that we are hoping for and expecting and so on and so forth. But just as a technical matter, I don't believe that you can authorize a ban without at the same time authorizing the bond to take it out.
Where the 950 came from, and this is, all right, we started off with 4.755 of infrastructure losses. Okay, that's the number that's embedded into the amendment. We assume that there's about $1.075 billion worth of insurance that will be fully drawn down. The residual amount of money we're expecting would come from FEMA or federal sources. The standard FEMA reimbursement is 75%. We just multiplied that remaining need times 75%, and what is still left is $950 million that we're saying if the number is 4.755 is the total loss, and if we get $1.075 billion of insurance, and if FEMA covers all of our losses to 75%, we will still be exposed for $950 million. So that's an estimate. It's our best estimate at this point in time. It could be higher, it could be lower. If FEMA gives us 90% coverage, then that number would be lower. If the total pot for New York is smaller, it could be bigger. If our expenses, if our costs are lower than 4.755, it could be lower. If our costs are greater than 4.755, it could be higher. But at this time, that's the best estimate we have, and that's what we've embedded into the financial plan.
One other quick question is pricing on bands. Do they vary significantly from other notes instruments that we put out?
No, I think we have in the past issued bans, so we have a sense of what we would expect to see, depending on the credit. Investors look at the rating of the credit, they look at the structure. The ban can take many forms. It can take a fixed rate form, where we'll just issue for example, a 2-year ban, and with a fixed rate. We can issue a variable rate. This gives us the flexibility to negotiate with banks to enter into bank agreements for letters of credit, for revolvers, for that type of lending. So, but to answer your question, we expect to take advantage of the short part of the yield curve between 1 year and 5 years, where rates are lowest right now.
The instrument itself doesn't have any innate advantage to us on a yield base, on a cost basis.
Oh, yes, absolutely. It's a short-term instrument, and it takes advantage. Well, yeah.
Yeah, I think if we were to try to go out and sell notes that were solely secured by insurance proceeds or solely secured by federal reimbursement, it would be much more difficult and more expensive. Putting the bond behind that, calling it a ban, makes it much more marketable, and we ought to achieve a significantly lower interest rate. That's it.
So is everybody clear now? So we need a motion, please? A second, please? All in favor? Any opposed? All passes. Thank you. Doug, you want to do the procurements now?
We have one more action item.
Oh, we do? Where do we?
Pat, you want to
Sure.
take it? Sure.
Next action item appears on Roman 5-67 of the committee book, and this is the authorization to seek authority for refunding bonds in the next fiscal year, provided such refundings meet the MTA's refunding policy. As you can see right behind the staff summary is the refunding policy that was adopted by the board on May 26, 2010. We're not proposing any changes to that. That policy lays out the minimum savings requirements that we expect to achieve in a refunding. If those requirements are met, this board is authorizing staff to execute refundings to take advantage of market conditions from time to time in 2013.
Move it.
Excuse me. All in favor? Any opposed? So moved. Doug, the procurements?
Sure. We have no procurements for headquarters. For the Commuter Rail Committee, we have 2 procurements for Metro North for a grand total of $600,000. One procurement is non-competitive and one is competitive with capital construction.
Okay. Second, please. All in favor? Any opposed? So moved.
MTA bus operations, we have no items. Bridges and tunnels, there are no items. New York City Transit, we have 1 non-competitive procurement for a grand total of $414,126.
Motion, please. Second. All in favor? Any opposed? So moved.
Doesn't always get in here.
Okay, there are no items for FIMTech. And that would conclude the finance portion of the meeting, and I'll turn it over to Jeff.
Thanks,
Jeff, on the real
portion.
estate, please.
Thanks, Doug and Andrew. We have 3 action items for you this month, summarized in the staff summaries in your book. They're relatively minor items: 2 coffee and newsstand concessions for Metro North, and agreements to facilitate a widening of the connecting corridor at Penn Station using U.S. DOT funds. That will be undertaken by Moynihan Station Development Corporation.
We're not doing C.
Sorry?
We're not doing C. Correct?
No, I believe that was. Oh yeah, okay. I'm sorry. I have them renumbered on mine. That's right.
In the book, we're not doing
Yeah,
C.
there was a little glitch there, a discrepancy between the survey and the appraisal, so we're reconciling that, and we expect to be back next month with that.
A motion, please? Second, please. All in favor?
Aye.
Any opposed? Motion carries, Jeff.
Thank you.
Now we need a motion, please, to adjourn our meeting.
Motion.
Second, please. All in favor? Thank you very much. See you Wednesday. Everybody has the same questions.